Hey fellow investors and fellow stock guardians, it's Friday, February 26, 2021. I'm Hoda, co-founder and CEO of StockCard, reporting to you from a mostly red stock market. Except the Nasdaq index that managed to finish Friday in the green, the market indices hovered in the red zone for the most part. The weekly new jobless claims report came out yesterday and the number fell by 110,000 compared to the previous week. That's good news for the economy. The House of Representatives are working on the Biden administration's $1.9 trillion package. If it gets approved today, it would boost the economy forward, but it also comes with the possibility of rising inflation rate. Such a worry is among the reasons the stock market indices had a rather tough week this week. Today we have a tale of two companies who lost 80% of their revenue due to the pandemic. One's performance was cheered on by investors while the other one got crushed. Let's see why. The winner stock is Airbnb. This recent IPO just announced its latest quarterly earnings report, and it managed to impress investors with its better than expected results despite the decline by 80% in its revenue. Such a revenue drop didn't matter to investors. Airbnb has a light asset business model. Unlike hotels and other travel and hospitality companies, Airbnb doesn't own the houses it rents. This means it doesn't have to maintain them if it doesn't rent them out. That makes the company's business an asset-light business model, and such model has worked quite well for Airbnb. If Airbnb can stay ahead of the rest of the industry, it can be quite successful when the world goes back to normal. On the company's stock chart, there's quite a lot of missing information. Since Airbnb is a new IPO, many of the key information are missing. That usually means you are taking risk related to the lack of information and operational history. If you're adding this company to your portfolio, remember that you are taking such a risk that is associated with new IPOs. The loser stock of the day is a company called Zynx. This company also lost 80% of its revenue due to the pandemic. Zynx is a medical device company that manufactures pain management devices that can replace traditional painkillers. Its stock fell more than 16% today after a disappointing performance in 2020 and lower than expected forecast for Q1 2021. Before the pandemic, Zynx was a rapidly growing stock with free cash flow, no debt, and profit. However, because the company offers a new alternative pain management solution, it has to send its sales team to doctor offices and train them about the benefits of prescribing Zynx device instead of traditional painkillers. It seems the company's sales team weren't able to successfully replace the in-person meeting with virtual ones, and that's why the revenue has dropped by more than 80% in 2020. Overall, it seems Zynx can be one of the stocks benefiting from the return of the world to normal life. However, it is noticeable that the company wasn't able to quickly adjust to the new norm during the pandemic. If you're adding this stock to your portfolio to take advantage of the lower price, make sure you're considering that risk. Let's wrap up the week with an update from the Securities and Exchange Commission, also known as the SEC. The SEC is the organization that regulates the stock market and makes sure all market participants oblige with the regulations. It just made a quite interesting decision to halt trading for 15 stocks that are hyped by social media. The list includes several hyped up penny stocks on social media by traders. Hyping up stocks, which is also known as pump and dump, is the most common danger of investing in penny stocks. While they may seem cheap and have the potential for excellent return, there is always a chance that penny stocks you're interested in become the target of the pump and dump activities, especially on social media. And that's exactly why on a stock card, we've added penny stocks filters and toggle so that you can always have the option of screening out those risky companies and stocks from your search result or from your research if you prefer to avoid the pump and dump risk. As always, if you like to give a stock card a try, research as many stocks that you want and receive updates about the stocks and portfolios you're following, sign up for a 14-day free trial with promo code ROLLWITHOURCEO, all lowercase and in one word. That's it for today. If you like these quick market recap reports directly from my daily stock market research, please like and subscribe and share with your fellow investors. I'll see you next week.